Hi guys, this is Ruby Velasquez with MRB Financial. Thank you so much for joining us for today's topic of the week. As always, please don't forget to like, share, and subscribe to our medias. For today's topic of the week, we're going to talk about student financing. So if you know any student going into college prepping, if you know this is your junior, senior year, a parent, this is a very good topic for them. So if you have any questions for us, please don't hesitate to reach out to us. So let's get on with our topic of the week. Student financing options. This is something that, as you're starting, it is very it is daunting right at the beginning. So let's get on with what is a loan. Basically, a loan is something that you have to pay back, money that you have to pay back with interest. There are several types of loans available. There are federal government loans, private sources such as banks, credit unions, state agencies, or financial institutions, and also other organizations. They are designed to cover, anything that's related to the tuition of the student, room and board, academic fees, books, classroom equipment, and possibly transportation as well. Let's get on with the federal loans. How do those work? The current interest rates after July for both subsidized and unsubsidized are 2.75% for undergrad programs. That's a 4-year bachelor degree. And for graduate, a master's program or professional above, 4.30%. The rates are fixed for the life of the loan, and the typical term of the loan could be 10 to 25 years. The two differences between the federal subsidized and unsubsidized is who pays the interest while you're in school. When you apply for financial aid at your school, they will most likely have you fill out all of your income information, and that's going to help them determine a lot of different factors on the financing that's most appropriate for your students and what they qualify for. The subsidized and unsubsidized loans are eligible for students to help cover, as we said, all of the education for a college degree, university, community college, or trade school, career, or technical school. They are also known as Stanford loans or direct Stanford loans. So you may have heard that term before. There are limits on the amount of the subsidized and unsubsidized loans that you may be eligible to receive each year, which we'll go over that in a few slides, and the total amount that you basically will get at the annual level. To become eligible, there are guidelines as you do need to be a U.S. citizen or a resident. So be sure that you check that if there's anything that you got to work on. The direct subsidized loans are available and have slightly better terms to help out students with financial need, meaning that, it's not based on merit. It's do you need this type of loan at this time? Your school will determine the amount of money that you could borrow. It's basically like buying a car, like buying a house. It's like buying anything else. They're not going to let you borrow more than that you need. If the college costs, 100,000 over a 4-year, then that's all you're going to qualify for. It's not like you could get more than you should. As far as the subsidized loan, the U.S. government will pay the interest while you're in school at least half time And then for the 6 months after you leave the school, which they refer that as a grace period. And then during a period of deferment, if you happen to be at a deferment later. Note that if you received a direct subsidized loan that was disbursed before July 1st, 2012 in 2014, you will be responsible for paying any interest that accrued during that time. If you choose not to pay the interest that accrues during your grace period, the interest will be added to your principal balance. So very important to understand that, when you repay your loan, be sure to understand the options and the responsibilities that come with the loan. Now, the direct unsubsidized loans, they are available also to undergrad and graduate students. There is no required to demonstrate the financial need, meaning that the unsubsidized, you don't have to prove that you need it. If you qualify within the guidelines, they will go ahead and approve you. Again, your school will let the amount based on the loan that you need, and other, you may have grants, you may have scholarships. So what they do, they lump them all together, and they cannot exceed the total loan amount. For the unsubsidized loan, you are responsible for paying the interest on the loan itself during all periods. If you choose not to pay the interest while you are in school and during the grace periods, or for deferment or the forbearance periods, your interest will accrue and will be capitalized. Your interest will be added to the principal amount of your loan. So very important to understand the two differences between the two loans. Subsidized, the government pays the interest that you are earning on the loan, while not earning, I'm sorry, accruing while you're in school or on some type of deferment. While the unsubsidized, you pay interest at all point in time the minute that you obtain the loan. Along with these, the federal loans, there's the Direct Plus loans that's for graduate and professional students, and then the Direct Plus loans for parents. The parents are fully responsible for paying these loans, even though they are taken out for the benefit of the student. So be sure that you do have a conversation with the student, letting them know, that this will affect you if you don't pay this loan, because now you've become the owner of the loan as the parent. A lot of parents have the misconception that because they took it out on their name, it stays on the student. It does not. It actually follows the parent. So there are situations where the student is 3 years into their degree program and they don't qualify to get their own loans. There's dependent and independent loans. They might not qualify for them. So they will ask the parent, can your parent co-sign for you? This is where those loans come in. They do stay on the parent as the person that obtained the loan. As far as what special terms the federal government offers, is they do have special terms for any military personnel, anybody that's going into the military. So be sure to ask for that. Healthcare professional loans also have special terms, such as limited interest rates, no accrual of interest, and deferment of student loans. As far as private loans are different. Think of a private loan as if you're going to buy a car or a home. They're gonna be treated differently than the federal loans. These loans are private lenders, there's banks, finance institutions who go based on your credit. They don't necessarily go based on the school, nothing like that. It's a personal educational private loan that you're obtaining. They do vary dramatically from one company to another one. If you don't have a good credit history, you will need a cosigner to qualify. And you should always carefully review the loan terms and go over them with your designated cosigner. If you needed a cosigner, let's say your parents needed to cosign for you because you just graduated and you don't have a credit history, your parent will be liable for the debt as well. So very important that everyone understands the terms. Um, as far as the interest rates, repayment plans, and loan limits, they also have their own. Private loans often come with variable interest rates. So that's very important to understand because that means that every month your payment can change for the life of the loan. Um, Federal student loans are not available for law and medical students after they graduate, so a private loan may be a good avenue for someone in this field. A bar study loan is also awarded to law students to pay for the exam costs and living expenses while studying for the exam, and then also any residency and relocation loans. Those are designed to help with medical and dental students pay for costs while they look for a residency or somewhere to relocate. As we said, the interest rate is variable for the life of the loan. Typical terms can range from 15 years to 25 years, and the current interest rates are 2.8% and 1.24%. The reason why you see the LIBOR, I think I'm saying it right, 2.8% and above, and the prime rate 1.2% and above is because these are the two different types of indexes that the private lending institutions use to let you borrow the money. The prime rate may look very attractive because it's lower, it's 1.24, but the thing about it is that it follows today's market. So a lower interest rate may not always be, if you know, you got to be careful with understanding which way they go. The LIBOR, the acronym for the London Interbank Offered Rate, tracks what it costs banks to borrow money from other banks. It represents the recent average interest earned by deposits in the London market. The prime index is short for prime lending rate, reflects the lowest rates currently offered by banks. So that is the biggest difference between the two. Very important that when you are shopping around with a private lender, that you make sure that you look into the lender itself. Private loans tend to be the very last option for your financial application, which is called FAFSA, for them to assign it, just because of, you know, the high interest rates that they come with and the variable interest rates. So let's talk about the limits. The limits for federal undergrad students, that is a 4-year bachelor degree, if the student is considered a dependent, the limit per year is $5,500, year 2, $6,500, and year 3 and above is $7,500. For an independent student is $9,500 for the first year, $10,500 for the second year, and $12,500 for 3 years and above. The difference between dependent and independent is, you know, if you have a student living at home with you, no children, not married, they would be considered someone's dependent. If you have children, if you have a home, you are considered independent. For the graduate or professional students, there is nothing for dependents because, you know, you at this point you are considered independent. The yearly limit is $2,500. And then for the private undergrad, the limit per year is $30,000. As you could see, that's higher. And then cumulative, $120 to $150 per year. The graduate degrees have higher limits, so you may be able to see higher than 150. So what do all these numbers mean to you? Let's use an example just so that you can understand this a little bit better. When you apply for FAFSA, they basically, collect all of your information, what degree you want to go into, what is that going to cost? How much money do you have available? So then this is where you will pull, if you have been saving for college, you will pull your 529. Now is the time for you to pull all your investments so that you can pay for school more upfront and avoid getting loans as much as possible. So the way that it would work, let's say that a 4-year degree will cost you 100,000, but you have 20,000. Well, according to the federal undergrad limits, you're gonna only qualify for, let's say, a dependent child, 5,500 for the first year. Let's say the first year, each year it costs you 25,000. Let's give it right now. The actual college average runs you between 20,000 and 40,000 with a private university, depending, of course, on the name brand of the university. If you're looking at the lower end, you're going to look at, about $20,000 per year for a student. And, it could go up to 40,000 depending on the school that you attend. So let's say year one, you found your 529 and you have $20,000 available. Well, that's going to be able to cover just the first year, and you may need to obtain a $5,500 loan, or you could pay as you go. A lot of the college institutions will just put you on a payment plan for something small like that. But let's say that you are at the school where it costs you $40,000 per year, then you're going to need to come up with an additional $15,000 for that year to put your student through school. Or if you are that student, that's how much you're going to need to cover the rest of the year. The following year, year two, you know that you can qualify for 6,500. Or let's say that you're an independent student, either 9,500 for the first year or 10,500 for the independent for the second year. So they do give you, this is how much we're going to loan you for the 100,000 for the 4 years, but then they break it up into each year. So very important to understand, not think that you just have 100,000 to borrow and you could borrow it at any time. They actually put limits on that. So then if you run out of the federal student loans, then this is when the private lender comes in. So they put everything into buckets. They'll say, how much cash do you have? Like anything else, how much cash do you have available first for you to start paying for your school? Then we're going to go to federal loans, because they're the most attractive, because they have those fixed interest rates, they have better payment terms. They're just a lot easier to work with. And then very last case scenario, they're going to move over to the private loans if you don't have any grants or any scholarships. So let's talk about grants and scholarships. These are huge. If you are a junior in school right now, a senior in school, this is the perfect opportunity for you to start to stack up those grants. Most types of grants, unlike loans, are sources of free money that generally do not have to be repaid. Grants can come from federal government agencies, state government, your college or career school, a private not-for-profit organization. Do your research and apply for grants that you may be eligible for, and be sure that you meet the application deadlines, because there are deadlines to follow. If you miss it, what happens is they run out of money. So you need to go in and check, okay, let's use these examples of the loans that are available. I'm sorry, grants that are available. The federal Pell Grant is a limit of, all of these have a yearly limit. All of everything that you're going to see, they have yearly limits. 6345, $6,345 for the federal Pell Grants. This is for someone that would qualify for this grant. Federal supplemental educational opportunity grants up to $4,000. Iraq and Afghanistan and service grants up to $6,345 per year. And then the teacher education assistance for college and higher education grants are also available up to $4,000. There are other grants as well, such as if you are in the military, if you have served our country, there are grants that are based on merit rather than the financial need. And then this is the biggest thing to look out for. Is this grant merit-based, financial-based, or is it on a special talent? Most grants are awarded only to students with a financial need. So look out for those kinds of questions to ask. The requirements for remaining eligible to receive a grant vary from program to program. Certain scenarios may require that a portion or all of the grants be repaid if you, let's say, you quit school. Before you fulfilled your contract, that they were giving you this money because you needed it, and then you dropped out of school. That is one scenario. Or if you receive, you just didn't complete your service hours. That's another scenario. Scholarships are gifts. Scholarships are based on grades, heritage, religion affiliation, and other factors that will qualify you for these. They do not need to be repaid. There are thousands of them out there offered by different folks like schools, employers, individuals, private companies, not-for-profits. There's communities that offer them for their community members, religious groups, and professional and social organizations as well. Some scholarships for college are merit-based. You can earn them by exceeding a certain standard set by the scholarship giver. Merit scholarships might be awarded based on academic achievement as well, or a combination of academics and special talent, traits, or interests, other than scholarships based just on the financial needs. So, if you are a sports family, there's people scouting out all the time, looking for the best players. That is one scenario that I could think of. Let's say you have a high GPA. This is very common if you are academically inclined, you have a high GPA, you have good attendance, you're into sports, you have all of this well-rounded student portfolio that they like to see. Schools may offer to cover, for half of your tuition. The school itself may offer you to say, you know what, if you come to my school, I'm going to pay 50% of your tuition. I'm going to pay 75% of your tuition. I'm going to pay 100% of your tuition. So if you have been, if you have had a special talent throughout your lifetime, look to see if there are any scholarships for you, for your student. This is free money. You don't have to repay back, but, the scholarship giver may set some rules for you to follow for them. It might cover the entire cost of your tuition, or it may be a one-time award. It may be a few dollars. You could even stack them up as well. As you're stacking up your scholarships, remember that you need to be able to pay for school. So if you go over, let's say that for year one, you're that, $40,000 student, or that $25,000 student that needs to come up with this money to pay your each year, you can look right away to see what scholarships are available to you. Start to gather up all these scholarships and, just pull your money together and see what opportunities you have. You can learn more about scholarships in different ways, including definitely the financial aid office at your school. They usually take you through the process. FAFSA, they're usually pretty good about, telling you all of the options that you have. But also check, your public library. Check online. But one thing that I'm going to say is please be careful out there when you're looking for grants, when you're looking for loans, when you're looking for scholarships, when you're looking for these types of funding, because there are some companies that you have to look out for to avoid any scams. Scams are everywhere. Unfortunately, they're in any lending institution, anything nowadays. We have to look at everything 4 or 5 times to make sure that everything makes sense. To apply, there are deadlines. Some of them will say as early as a year before college starts. Some of them will say while you're applying. Some of them will say during the summer. Some of them will say only for seniors. So do look at all those deadlines. Some of them may require you to write a paper, do some kind of project. Like, they all have their own special things that they attach to the scholarship to make it, worth your while. That's as far as where the money goes. It may go directly to you, or it may go directly to the college. 99% of the time, whether you're getting a loan, a grant, a scholarship, they're all going to send the money to the college institution. If they send you the check, it would just be a matter for you to, make your payment to the financial institution. Otherwise, they may come after you for that. It will affect your student loan aid, because of all of the students, once they pull all the money together, they may come back and say, oh, we're gonna, because you qualified for this other scholarship or grant, we're gonna reduce our grant. So that's the main thing to understand. How, when you're putting all of these pieces together, how do they affect each other? Am I gonna lose a bigger grant because I got this small scholarship? Those are things that, as a parent, as a student, that you will need to consider. So that brings me to the end of our topic for today. I hope that this information was very valuable to you. If you have any questions for us, please do not hesitate to reach out to us. But yeah, and to wrap up everything that we covered today, it is very important to understand the loans, the grants, the scholarships. As far as the loans, is it a federal loan? Is it subsidized? Is it unsubsidized? If it's subsidized, who pays the interest? So be sure to understand all of those things, and then your yearly limits, because that is going to help you succeed as you're paying down your student financing. We thank you again for joining us for our topic of the week. Bye.